every single time, and this is important, this is the part where you start writing down these details. Every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. I immediately label that in my mind, not on my chart, because I don't want anything distracting me. If I have these things written on my chart at the time, it's going to be a distraction to me. But the way I'm internalizing it, and you'll see what I mean as I go through this lecture, every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, that's an intermediate term low. So when the market traded up into and just above that fair value gap high, this red level here, once it started to break down and go lower, it traded back down into this candlestick's high. So we're trading back inside this range, and we're range bound. Since I am expecting the daily chart to be the parent of this price structure, all minor lower time frame swings are going to be subordinate to it. And what does that mean? This now is a long-term high. I do not expect this high to be broken to the upside. Should it be broken to the upside, that means that my daily analysis, expecting this level here to hold price and to be a factor in the algorithm repricing and going lower at a later time, if it goes above that, then I'm probably wrong in my analysis. So therefore, I demand more information by studying more price action and sitting on my hands. Or if I have a trade on, it means that I have to admit that I'm wrong, and the stop out that may occur is just me managing risk. It's a losing transaction. It does not mean your model is flawed. It does not mean that you're a failed trader. It just means that that transaction was not a profitable one, and it's just a cost of doing business. But as long as price remains below this high, my idea is this is a long-term high, because it's framed on what? A higher time frame resistance level, if we want to talk in terms of retail ideas, so that way we can understand something in a simplistic manner, but we'll build on the ideas that will help move you away from simple support resistance ideas. So this long-term high should remain intact. In other words, price should not go higher than that. We trade down to the discount level of the low end of that fair value gap, and it starts to find support, rallies back up, trades near the high but does not take that out. Very important. Once it starts to break down and consolidate, in here, retail ideas will see a lot of trust in the idea that's potentially a bull flag. I love seeing those patterns because I like to fade them. So that's a false bull flag. And when we see price break down like this and then rally back up, every single time, and this is important, this is the part where you start writing down these details. Every single time price rebalances an imbalance, like we have this candle's low, this candle's high, we have that one single candle passing down like that. Once that rebalances by going up here, that swing high from this high, and this high, that's a swing high right there. I immediately label that in my mind, not on my chart, because I don't want anything distracting me. If I have these things written on my chart at the time, it's going to be a distraction to me. But the way I'm internalizing it, and you'll see what I mean as I go through this lecture, every rebalance of an old imbalance, that swing that's created at that moment, I immediately label that in my mind as an intermediate term high, or in this case, as we came back down and filled in this by dropping down here, that's an intermediate term low. What does that mean? What's the significance of that? Typically, what you'll see is an intermediate term low has a higher short-term low to the right of it and a higher short-term low to the left of it. This intermediate term low forms by rebalancing, but it has a higher short-term high here, but then the market trades over here off of this short-term low. It rallies up, but it fails. It fails in here. We're going to anticipate that failure. Whereas if you're looking at this low, high, higher low, failed, higher high, higher low. So what's forming here? A pennant. You have to look at the relationship to price action and the relationship of how it behaves. What is it indicating? What is it showing? The market has traded higher and then consolidated. We failed to go above this important high back here. That's a long-term high. Then we have an intermediate term high. Why? Why is this an intermediate term high? Because we have a short-term high here and a short-term high here. So between two short-term highs, the highest high between those, that's an intermediate term high. But the main takeaway for your notes so far is anytime a imbalance, like this big candle up, is rebalanced, that becomes an intermediate term low. Just as well on the opposite end, this down move here, that's a fair value gap. As soon as it rebalances there, that's what I classify as an intermediate term high. Now here's where we take a huge step forward.
So let's talk about what the professional perspective is when we're applying market structure. Well, obviously for position trades, this is going to be anywhere between 3 to as much as 6 months to a year in terms of duration. Now, I don't have a whole lot of types of trades like this, but every 3 to 4 months in the marketplace, whether it be in stocks or commodities or forex, there is a specific swing that manifests itself, and we talked about that in other videos and other teaching. I'm not going to cover that here, but if you are that type of trader, obviously the 3 time frames that you would utilize to break down market structure for your particular market would obviously be monthly, the weekly, and the daily. Okay, monthly being your highest time frame, your weekly being your midline or mid-level time frame, and then you have your daily. That would be your short term. Now, as a swing trader, okay, your premise for breaking down market structure will be comprised of looking at the daily, the 4-hour, and the 1-hour chart. Okay, your setup will be based upon what you see on the higher time frame, the daily. Much in the same capacity for a position trade, the monthly will be your position trade premise. In other words, if we are considerably overbought, there should be some kind of a topping formation on the monthly chart, you would look to see market structure break down on the weekly and daily to facilitate a short position. Well, on a swing trade model, you would utilize that same measure of market structure by utilizing the highest time frame for swing trades. In this approach would be the daily chart, and then breaking that down into 4-hour chart, and then lesser price action study in the 1-hour chart. So you'll be timing on the 1-hour, you would be managing on the 4-hour, and the premise or the trade idea would be built upon the highest time frame, which would be the daily chart. Okay, in the swing traders model here. If you're a short-term trader, obviously the duration of time for these types of trades could be anywhere between 1 day to as much as a week or so. Swing trading is about a week or more in terms of trade duration, and I forgot to mention that. But for short-term trades, you'll be using the 4-hour chart for your trade premise or your directional bias. And then on the 1-hour chart, that would be your trade management or mid-level time frame. And then your 15-minute chart would be utilized for your timing for entry and possibly looking for early reversal signs that your trade may be petering out and it's time to take profits. For day trades, obviously, you can see it's the 1-hour chart. It'd be your highest time frame. You would be managing your trade on the 15-minute time frame, and your 5-minute chart would be utilized to enter. Now, it's not to say that you can't use a 5-minute chart on the short-term swing and position trades for entry. Okay, I'm giving you the framework for at least having 3 time frames across the spectrum of your trading, and how you break down market structure over these 3 specific time frames for each individual trading model will give you, again, the building blocks to flesh out what you need to see in terms of directional bias. Okay, so let's take a look at closer look at price action and market structure. Now the keys to multiple time frame market structure, okay, are rather simple. Where's your focus? Your focus should be on the highest of the 3 time frames. Trades will be managed by the highest or mid time frames. Okay, in other words, if you are a swing trader, you're going to be utilizing that daily time frame to manage, or the 4-hour chart to manage your trade. Okay, but the daily is going to be utilized to facilitate the trade premise. In other words, that's going to give you your directional bias. Okay, the market structure that is on the daily chart, that's framing your swing trades. Okay, once you get into a trade, you would be managing that trade on a 4-hour time frame, and you would just use the respective time frames we just talked about in the previous slide. And then your 1-hour chart would be used for timing purposes. Okay, so the shortest time frame in that regard for swing trading would be the 60-minute chart. So your entry signals would be derived from having studied the market structure on the daily and the 4-hour. Then your 1-hour chart would facilitate the specific entry point. As price rallies up into what we would perceive as a higher level key resistance level, price never moves in a straight line. Okay, so there's going to be a consolidation, a price move up, another consolidation, a price move up, and then as price makes it into this resistance level, then we would be anticipating a reversal. So when markets start to break down, taking out short-term swing lows in here, this short-term swing low, when the highest time frame for your particular trading model, once that breaks, this would be the catalyst for you to say, okay, this is probably going to be an optimal trade entry based on the higher time frame chart of your profile. Okay, so for an example, let's just say that this is a monthly chart and you're looking for a position trade. Okay, if the monthly hits a key resistance level like this and it comes down and takes out a short-term low in the monthly, we know now that market structure has broken. Okay, so we have a market structure shift right here. Okay, now we don't know what price is doing over here. This is all in the future. We're anticipating these types of events in terms of price action, but until it actually gets there and starts trading, we can't deal with that yet. So it's all in anticipation in our anticipatory model as far as our framework and thinking about price action. This is what we would expect to see once this structure has been broken. Okay, but as price starts to rally up, we don't anticipate seeing a break through this resistance level. Okay, if we arrive at this as a possible resistance level, we would expect a retracement for an optimal trade entry, but then we would zoom in this area right here, okay, on a weekly time frame to hone in on more key shorter term time frame price levels. And then by zooming in, okay, we would possibly see a shorter term optimal trade entry or respective sell pattern to, convince us even further that this is probably going to be a selling scenario. And if we move down into a daily and see something even similar to that, okay, you would have all these nesting confluences of implied resistance levels. Once a higher time frame market structure is broken down, and then we would be able to position ourselves in sync with a top-down approach with market structure. Okay, and then as price starts to trade down, this is the gray area. All these areas where there's missing gaps, okay, that's intentional. Okay, we don't know what's going to take place between the time where we see an entry point and where we expect to see price get to in terms of our targets, and we'll talk more about that later on. But this is the gray area where you have to be comfortable with, okay, because you don't know what's going to happen from where your entry point and your expected exit point. Okay, you don't know if it's going to go down there. Okay, you don't know if it's going to reverse and take you out of the trade. Okay, but the overall framework, okay, or price structure, Okay, this is how market structure is built. Okay, this is a price rally and a decline. Okay, we have consolidation. If we expect to see some kind of a rally in here, something's bullish that we would expect support at, as price starts to rally up, okay, we could be utilizing our mid-level or shorter-term level time frames to see bullishness. Okay, we want to see support being held, resistance being broken. Okay, and every time price starts to pull back and retrace in here, the market structure concept that you would be utilizing would be to simply look for optimal trade entries. Okay, for buys, you would be looking for reflections to buy. You would be looking for type 2 trend following bullish scenarios. So in other words, in all this area here, you'd be looking for price finding support and resistance being broken. Okay, it's that simple. That's the whole framework behind market structure. And as price rallies up into another shorter term or intermediate term resistance level in here, price will hopefully find some support. Okay, but if it does start to break down, be comfortable with price coming back and blowing out previous lows in here. Okay, there may be an important low that's taken place, and trailing stop loss orders would be trailed up below that particular point. Okay, so as price dips back down, all that's going to do is give you another opportunity to get long. Okay, now again, let's think for a moment. This is the higher time frame premise. Okay, this is the highest time frame chart. When we start seeing this consolidation in here and we see the higher level resistance level, because these are all known in advance, this is why we have support and resistance studies done. This is all part of our top-down analysis, seeing where price may be reaching for. So if we start seeing price rally up in here and then consolidate again, and this is another higher level key resistance level, if price continues to maintain support and breaks above all of these short-term highs in here, the market structure implies that we could possibly see a leg from this low, or whatever low would form back here, to this high, duplicated on the retracement here from this low to this high. The same thing could be said with market declines and reversals going long. Every time we see a consolidations, you want to study these for shorter term, more dynamic support and resistance levels. These areas are more easily tradable because they have discernible price levels. They're very clear. We don't know how it's going to take price from these consolidations to the next consolidation. We don't know that. We anticipate that gray area that's missing, these little pieces of market structure that's missing. I left that out because I want you to think like this. Okay, if it's a little confusing now, I understand, but if you apply this same general, I don't want to say profile, but this diagram, okay, in other words, in terms of how I have price lows illustrated here, if you look at how price declines actually materialize, you'll start to see these lows form like this, and inside of those consolidations and every swing low that forms, there's going to be discernible optimal trade entries or reflection patterns, or generally fractal patterns. Okay, so you would apply these concepts, okay, with all the other concepts we've previously discussed, but looking at obviously a higher level key support level down here as a catalyst. Okay, so as price moves from a consolidation down into a new consolidation, much in the same capacity we just saw with the bullish move reaching up into a higher level resistance level, we could be seeing a consolidation in here with this higher level support level down here. This would be where price may be reaching for. So if it's consolidating here, we could look for a move from whatever high forms here to this low, okay, duplicated from this high or whatever high forms in this area down to this low. Okay, so while this diagram is fragmented, okay, think of in terms of the market maker profiles that I just recently shared with you guys this year. You see that same premise here as well. I don't need to draw the lines in here. You can actually probably remember by the way the profile was given to you. You can actually see it in here. Okay, so as price is engineered to go lower down into a support level, ultimately to trade higher, this is the building blocks that we work with. Okay,